My name's Michael Pollock. I'm head of media and communications here at CreditorWatch. I'm very pleased to welcome our panelists today. We've got Ginette Muller and Ivan Colhoun. Ginette is a director of GM Advisory, a corporate advisory firm based in Queensland. Ginette holds qualifications in accounting and law and has significant commercial advisory experience, having held senior roles in many of the large accounting firms. She's a former ASIC registered liquidator who now helps directors work through problems implementing safe harbour, good governance and restructuring. Ginette's also a regular contributor and speaker for insolvency courses. And she's recently completed writing the Small Business Restructuring course for Bond University, which I can say is open to anyone for a small fee, and it will be available online later next month. Is that right, Ginette?
That's correct, yes. Bond's about to launch that around late July, early August.
Great. We look forward to that. We also have our good friend Ivan Colhoun, Chief Economist at CreditorWatch. Ivan is a keynote speaker on the economy and financial markets. He joined CreditorWatch in September 2024, and prior to that, he was Chief Economist for Corporate and Institutional Banking at NAB. He's also been Chief Economist for Qantas and ANZ and Deutsche Bank, and has consulted to Seek and Virgin. Welcome to you as well, Ivan. Can you hear us there, Ivan?
Yep.
Okay.
Sorry,
okay,
microphone was off, so yes. Hi, Michael.
Okay.
Hi, everyone.
You're good. So for those of you who aren't familiar with CreditorWatch and what we do, we are Australia's only dedicated B2B credit reporting agency. We were founded in 2010. We now have 250 plus staff. We have a unique and growing data set. Our trade lines, which are lines of credit between businesses, has grown around 34% in the past year. Our credit rating system is AI powered and predictive, and we are an industry leader in terms of our uptime. We have 99% plus average uptime over the past 3 years. So the business continuity of our members is always at the forefront of what we do. Next slide, please, Ivan. Ivan, you there?
Yep, it's a little delayed.
Right, okay. We incorporate around 50 plus data sources, public and private data sources, into our models. The common data we include comes from an intraday feed from ASIC. We have ATO tax default data that's sent to us on a weekly basis. The Australian Business Register, Australian courts, AFSA as well. And then on the other side, we collect unique data on payment defaults, a leading indicator of business insolvencies, mercantile inquiries, credit inquiries. We have accounting software integrations that we collect data from, corporate age trial balance data, and then our geo risk data as well. All right, so moving on to today's webinar, the FY26 outlook for business conditions and insolvency. I think all of you are well aware that it's a turbulent time for businesses at the moment, with cost pressures combined with lower consumer demand. And then on top of that, we have the uncertainty of the tariff regime of the Trump administration, which we'll go into in more detail shortly. So hopefully throughout this webinar, Ginette and Ivan can shed a bit more light on the state of play in insolvencies and the economy, and what, as a business owner operator, you should look out for over the coming 12 months. I'll hand over to Ivan to take you through the macro outlook.
Oh, I think it's Michael. Me, actually. Sorry.
I think I was just going to start the first 3 slides and then pass to you, Ginette, and then we'll go to the macro.
Okay.
Okay. Okay. So just the background we've been seeing is that obviously there's been this sharp rise in insolvencies since the low points, the low point of the COVID pandemic. What we've been noting in our data, though, recently is that we've been levelling out at quite an elevated level. So if you look at those sort of train tracks there, so far so good. We haven't gone back above that high we saw in just the late last year, so that's a positive. The line, though, also makes the point that you have to look at insolvencies as a share of all the registered companies. So if you look back in history, this sort of monthly rate of insolvency probably at the lower end of a normal range that existed in the early 2000s and mid 2000s, and it's not super high. It's higher than it was pre-COVID, but it's sort of at the low end of what I'd call a normal range. So the number of companies has grown very, very rapidly over the last 10, 20 years, and so you should always scale it as a share of companies. Did you have anything you wanted to add there, Ginette? Actually, I'll let you.
Yeah, look, no. Well, Not really, other than 2 spoiler alerts. One, I was going to leave anything to do with Mr. Trump to you. And secondly, just basically wanted to talk about what I thought, what I'm seeing and what I would predict at this early stage of the conversation. And basically that I think that, there's this profitless growth going on, that businesses have growth in revenue to the detriment of margin, and I see margins declining, which is coinciding with high and creeping costs. And I think they're sort of the things that you're going to touch on at that macro level, and I just wanted to get that in early so it can sort of, when I add my lower level, sort of looking at the smaller end of town and the smaller business sides of the equation, we can sort of apply what you're seeing from that macro level with the sort of the predictions that I'm making. So what I'm seeing is basically if these declining margins, which are coinciding with these higher and creeping costs, are left unchecked, this is starting to cause this debt accumulation from the losses, which are usually funded by owner's equity or the tax office, or what we find is if they don't get funded, that's when we see collapse. And so I'm predicting that this profitless malaise is going to creep up on companies that aren't awake to it, and hopefully we're, as we go through the slides, your slides and mine, we'll sort of see how this is likely to play out. So that's really where I wanted to set my scene and my part of it. And the only other thing I'd mention is that part of these numbers, you'd sort of say that they've sort of changed because we've had a new insolvency introduced, a new small business restructuring. So these numbers also include not only liquidation, receiverships, voluntary administrations, but also the new small business restructuring as well, which was introduced in 2021. So obviously we didn't have it, but I don't think we're actually seeing an increase in numbers just because of small business restructuring. It's just that what might once have been a liquidation or a voluntary administration is probably now taken up in that small business restructuring component of this data set. So yeah, thanks, Ivan.
Yeah, okay, that's great. And look, that sort of mirrors with my thoughts a bit as well, because while I'm noting it's leveled off, we're not expecting it to come down much. So what we'll conclude, I think, is that there's still quite a lot of pressures on companies at this point in time. So one of the CreditorWatch proprietary series that we like to follow is business to business, what we call trade payment default. So when one business doesn't pay the other, and you can see they've had a similar pattern to insolvencies. It's a very good lead indicator of insolvencies. But again, you can notice that leveling off at elevated levels, but it has leveled off in recent months. So this chart and the previous chart, I think, why have those trends leveled off? We'll see a bit later. Ginette will show us what's happening with tax office defaults. I also think the income tax cuts that the government gave in the middle of last year, and some of those cost of living supports have been helpful, have flowed into the economy as well, and that's helped with that, arrest the rising trend. Just to highlight again why we follow those trade payment defaults so closely. When a company registers a trade payment default against another company, if they do 2 or more, you can see the probability of insolvency goes up very, very sharply from 0 to 1 to 2. So it's certainly a part of the CreditorWatch service that is provided. It's a very, very useful service and statistic to follow. Over to you, Ginette, on the trend in small.
Sorry, Michael.
Sorry, Ivan. No, we certainly encourage you to lodge your defaults now. Now's the time ahead of the end of financial year. And that's, of course, as Ivan said, contributing to the shared data that everybody benefits from. But not only that, it's also a very strong leading indicator of business risk. So, yeah, get those defaults in. Something I should have mentioned at the start, please submit any questions and we'll field them to Ginette and Ivan throughout the webinar.
Okay, thank you. This is a chart of restructuring appointments that we've seen in the last 3 years. What you have to remember is that small business restructuring was only introduced in 2021, so relatively new. The early take-up in the first couple of years was basically nil. And then, as you can see, it's sort of caught on and it's become more popular in the sense that people are aware of its existence and how it can be used. And just for those of you out there who aren't familiar with it, it's only available, as the name suggests, to small businesses. So you have to have your admissible debts or the liabilities of the company have to be less than $1 million, excluding employee entitlements and some secured creditor liabilities, to enable the company to utilize this particular restructuring tool. You can only do one every 7 years. That's both the company and any director associated with this type of insolvency product, really. So you can see here that in the start of this year, the numbers are still rising pretty significantly there in January, February, starting to level off a bit in May. But the reason I've left the 2024 numbers up is just to sort of say, well, in 2024, the total numbers of appointments were 2,400. It's going to be significantly higher for 2025. So we can safely assume that it's, unfortunately, it's not interactive. I wished it was, but on my website it actually is, which is where I've taken this from. Basically, you can see that small business restructuring is now 25% minimum, probably getting closer to 30% of all those insolvency appointments that Ivan had up previously, I think those numbers were running at somewhere between 1,200 and 1,300 appointments per month. Which was going to be about 14,000 insolvency appointments per annum, maybe getting up to 16,000. So a significant contributor. So it's an area where there's a lot more flexibility for debtors to get in, address the issues of their business, get their business right-sized, or address some of those things that I mentioned earlier, which is, revenue or growth in revenue for the sake of it, and not really looking at the core issues, which are basically have a look at your margins, address your costs, particularly in this market. Once you've got your business right-sized and you're making profits again, might have too much of debt accumulated, so there might need to be a small business restructuring appointment to help compromise those liabilities with your creditors to get over the hump and to get back into proper trading again. Most of the times we see that the major creditor in these appointments are the Australian Taxation Office. Their take-up rate in 2023 was over 90%. So in other words, they're approving over 90% of these proposals that are getting put up. That may have slipped back a little bit now, but pretty well received so far. Well, that's the evidence so far that these types of appointments are avoiding liquidation, which is seen to be a good thing. It's allowing companies to continue to live on and go forward. So yes, perhaps we can see why that's happening from Ivan's numbers. Sorry, Michael.
Can I just ask a question? Yeah. So obviously SBRs have been around since 2021. Why did we see such a huge increase across last year?
Well, a number of factors. We know that the tax office has been, gradually building up its collection methods, sending out the director's penalty notices and the other collection tools, which is the list that I know CreditorWatch has access to and reports on, where if you if you have debts over $250,000, you get reported. So there are all these different measures that the tax office is actively pursuing. Perhaps prior to that, shortly after COVID, they weren't as aggressive. So, some companies could have just kicked the can down the road. Now they're not able to do that. They have to address their issues and face them. So there's that push. There's also a number of practitioners who understand the process now a lot better than what they did before. And so they're actively able to help businesses to utilize this type of arrangement. It's not the sort of thing that, a small business would know how to do just off the bat. You really need to go and get professional and proper advice and assistance to implement one of these. And now a lot of the insolvency firms and a lot of the reputable pre-restructuring firms are able to provide that assistance to corporates. So there's that take up as opposed to going straight into liquidation. They can work through their issues.
And in your view, they were designed as a lifeline for businesses. Have they achieved that, or what's your view on their effectiveness?
Well, at this stage, I'd say that they're very effective. As I mentioned before, the statistics are that the tax office is definitely approving them. So the plans are getting up. What I need to see, what would be helpful, is some data from ASIC. And this might be something you can look into, Michael, and get them onto this, another ticker box of how many of the plans are successful and achieved and the companies go on to survive, right? So we know that the data from a voluntary administration and deed of company arrangements is not that great. So it would be, successfully completing deeds of company arrangements, etc. we'd like to see what the data looks like with the plans that are getting up, because if we say, for argument's sake, 80% of these appointments result in compromises with creditors, and by that I mean everyone's agreed, said yes, you can have a compromise of your debt, and then you pay that back over a period of time, whatever it is that you've said you're going to pay. I'd like to see what those percentages look like. Anecdotally, I feel like it's a very high success rate, but you know, let's have a look at the data.
Sure.
I think the other thing just that comes to mind with small business restructuring being a large part of insolvencies at the moment, we're also seeing a large part of the insolvencies being in the construction sector with firms with less than 5 employees, and a lot of sole traders. This is part of the reason that the impact of all these insolvencies probably hasn't been as big throughout the economy in terms of unemployment or in terms of really big knock-on credit losses. The other aspect of that is house prices have gone up a lot, and houses are often collateral for small business or for personal insolvencies, which are very low at the moment. So it's really been, even though it looks bad, the impacts for the broader economy have been a bit less than you'd probably expect, given the big increase in these insolvencies. So why don't we have a look at some of the macro slides and try and unpick why everything's been happening. So I always like to think about what's the starting point and then what are the big forces. So the starting point, of course, was COVID a few years ago. That was a huge, huge shock. But the economy has really been normalising and businesses have been getting back to normal since 2022. So that's over 3 years now. But, you know, COVID created these very big imbalances in goods markets when we had all those supply chain problems, in labour markets when you couldn't hire anyone, virtually no matter what you were willing to pay, and also in housing markets. And that's why the Reserve Bank put up interest rates. They wanted to try and produce or lower inflation and also help the economy rebalance a bit quicker. Now, when you think about the news in the last few weeks, where the Reserve Bank said inflation's back to target and they could cut interest rates again, well, that's certainly, cutting interest rates is a good thing. But I think one of the big stories, and Ginette mentioned it as well, is that the cost of doing business, the cost of living, just because inflation is back to 2.5%, it doesn't mean those costs have dropped. It just means that they're going up at a slower rate. And in fact, big price changes are always difficult for consumers or businesses. Big price changes where prices fall, if they're your selling prices, that could be cattle prices, lithium prices have fallen very, very sharply recently, or just a big increase in the cost of living. That does, it is a challenge to businesses and to consumers. If you looked at the economy that was being forecast before Mr. Trump and his tariffs, I would say that economists were saying we were getting close to a really near perfect soft landing. And I'd call a soft landing is one where you put up interest rates to lower inflation. Actually, inflation comes down. You can lower interest rates. That causes growth to re-accelerate, and it means unemployment doesn't go up very much. And that's what's been forecast. And so far, that's what we've been on track to achieve. Now, what about Mr. Trump? That's the uncertainty that's been put into the equation. So when I look forward to the fiscal year, businesses will be facing up to next year. These are, I think, are the big forces that we need to take account of. So I think the tariff policies are a very big one, they don't directly hit Australia. They're all indirect. They're the effect it has on the US economy, the effect it has on the Chinese economy and the European economy, indirect effects. I mentioned in my second big dot point, I still think those high cost of living, high cost of doing business are very important. Ginette mentioned profitless turnover, if you like. So it's those costs, they're still up there. And really the only way you can affect those, couple of suggestions perhaps. One, of course, is look for productivity improvements. Two, perhaps there are some opportunities to source inputs from China. That has obviously the US has got high tariffs on China, so maybe you might be able to get some better pricing out of some of your suppliers. The other thing I think is important is slower population growth. It was really strong the last few years, but the government is seeking to slow that down. And there's a range of longer term issues, which I've put mega trends in there. They're challenges for some businesses, opportunities for others. So that complex set of forces that is still going to be affecting our business outlook. And I think we can't really not talk about tariffs. This is a wonderful quote from JP Morgan Asset Managers Chief Global Strategist. I wish I'd written it, but it basically says tariffs almost universally have negative effects, pushing up prices, slowing down growth, increasing unemployment, diminishing productivity and increasing global tension. So if you look at the US, whenever the US economy slows or has a recession, Australia always slows down or has a recession. So this was a big deal. The good news is that the story is not as bad as it seemed initially. So Mr. Trump is threatening really big tariffs and then walking them back. So compared to what it looked like, it looks like US growth will be 0.5% slower this year. The CPI will be 1.5% higher, unemployment 0.3% higher. So those are not good outcomes, but they're not disastrous outcomes. There were much, much bigger impacts the world was facing if those initial tariffs and the escalation that occurred with China had come to play. So I'll give
Ivan,
you 4 indicators.
Sorry, before we move on, we just had a couple of questions come in about what the government could possibly do to get the economy going. Obviously, you know, there's been a reliance on high population growth and public spending to prop up GDP, but we've had persistent weakness in the private sector. What, in your view, are the levers that the government could pull to sort of trigger a bit of economic activity?
Well, look, I think the government has been contributing a lot to growth, as you mentioned. So I don't think that's particularly what we need. What has been happening, and it's been a deliberate policy, is the Reserve Bank has been slowing growth to allow this rebalancing to occur and to bring down inflation. Now, I think the biggest factor going forward now is that the interest rates are going to come down. They've already come down 0.5%. They're likely to come down another 0.5 to 0.75% before the end of the year. And I think that's going to be very helpful for economic growth. It's going to help confidence, and it's going to reduce some of the cash flow pressures on businesses. So businesses and consumers, which is a good thing. So I think it's more an interest rate policy is where we should do that. Longer term, we need some tax reform. Both sides of politics have been too scared to do it. every time any party mentions GST, the other party just runs this scare campaign, is they're going to put up GST. What we need is a package of tax reform where GST does go up, but income taxes come down and possibly corporate taxes come down as well, and you rebalance the tax take and the tax mix.
That's more sustainable. Yeah.
Finish up a few charts to look at, and this will give you the picture of what we've been. So I've got 3 favourite indicators. If you're not as excited about all these economic charts as I am, you can look at the unemployment rate. That always tells you how an economy is going. And it's been pretty stable in Australia at around 4%. So that's a good story. It's a very good story for credit. We'd be in a very different world if unemployment had gone up. And you can see Western Australia is doing a bit better. Victoria is doing a bit worse, but interestingly, Victoria's improved a little bit in recent months. So look at unemployment. If you want to know what's going to happen to the unemployment rate, look at job ads and forget about, I don't know if you can see the cursor. Can you see the cursor? Forget about this rise here. This was the very strong period of labour coming back into the economy after borders reopened. It's this trend here, this is plotted upside down. So this is saying the unemployment rate is probably going to trend up slightly. It's not saying it's trending up disastrously, but it's trending up a little. So that's why the Reserve Bank will keep cutting interest rates. And my third favourite indicator is the NAB Business Survey. We had the latest result printed or released on Tuesday. It's 0. That's the lowest since the start of COVID, and before that, way back after the global financial crisis. So I don't know how much of that is just tariff uncertainty. Maybe it bounces back next month, but if it's 0, that's telling you the economy. I'm not saying it's super weak, but it's soft, and that will cause, ultimately, if we get another reading of 0 or a negative, the Reserve Bank will be cutting interest rates a bit more, which should be helpful as well. If you look at that by industry and by state, the sectors that are weakest are manufacturing and retail. They have been for some time. The sectors that are strongest, mining's jumping around all over the place. I think parts of mining are doing very well, gold, copper. Parts aren't so good, lithium, nickel, and of course we've seen energy prices come down a bit as well. So it's quite mixed depending on what sector you're talking about. And then finally, if you look at it by state, Queensland's been doing the best, Victoria's been doing the worst, not dramatically weak, but what I'm focused on recently is just New South Wales doing a little bit softer, and also Western Australia, so and even Queensland last month. So those are big parts of the economy. I'd like to see those figures bounce back next. Have you got any questions? Why don't we go to Ginette, and then we'll have time for questions.
Okay. I found this chart. It was a survey that the National Australia Bank did. I thought it was very telling because it reflected what I'm seeing out there. The cost of doing business. We know there's a cost of living crisis. Well, there's a cost of doing business crisis as well. And basically, this chart shows what's keeping people in business awake at night. Rated number 1, cash flow, then profitability, 3rd, concerns about inflation and business costs, 4th, staff turnover and labour shortages, and 5th, concerns over government policies and red tape. Now, some of these things are easing, but they're there, and they're concerns, and they're the issues that small business are worried about. But equally, they're making some proactive adjustments to strengthen their financial position. So they're not just lying down and saying, woe is me. If we can go to the next slide, please. you can see some of the proactive measures that people are taking to tackle these challenges. And the top 6 are basically somewhat obvious, I suppose, but cutting costs, negotiating better terms with suppliers, ramping up marketing efforts to boost demand. But I'd stress, keep an eye on that margin. Otherwise, we go back to what we said before. You've got this profitless growth. 29% are reviewing their cash flow and working capital processes. 28% are investing in staff training and talent development to improve productivity. And 28% are adjusting their pricing strategies to ensure competitive profitability. 27% are improving customer communication and management processes. So these are all very good strategies to employ when responding to these challenging market conditions. And I suppose this comes on the back of what Ivan's identified as the issues that we're about to face. So we want to encourage businesses to be aware of these rising costs that, you know, whether it's your insurance, whether it's your these energy, etc., they're all easing up. Inflation may be on. I mean, Ivan, you could probably explain it better, but I suppose you're saying inflation is starting to get into that level where we want it, but that doesn't mean the business costs have ceased by any means, have they? They're still rising. Yeah, exactly. So we don't want to add to this problem, and this is why you know, people end up in an insolvency situation, is because they don't address these issues and they don't watch the margins. Well, anyway, the people that I'm seeing at the moment.
Yeah,
so,
if I could just,
yeah. Sure, Michael.
Sorry, the lag is tripping us up, isn't it? If I could just ask a question specifically on insolvency, are you seeing a shift in the type of companies that are entering into insolvency, whether it's by sector, by size of the business, or age of the business, things like that?
Look, not really. You know, I suppose the only ones you don't see are, well, all sectors are involved, really. I'm seeing everything. We've previously touched on the ones that are most at risk at the moment, which was hospitality and catering. I think we mentioned that. We often see the building and construction. And a lot of times it's contract negotiations. We have to look at the contracts that have been negotiated. Are they realistic? Have the prices? Have you priced that contract appropriately? Is there a sufficient margin for things to go wrong in there? Have you taken into account potential price rises, etc., etc.? So no, unfortunately, we see a little bit in every industry, every sector, because the fundamentals are pretty similar, right, across every business. It comes down to a really simple formula of making sure that you've got the margin to cover your overheads to make your profits. Otherwise, what's the point of being in business? Eventually, you're going to chew up either the owner's equity, which, okay, house prices are going up, and Ivan did touch on the fact that a lot of small businesses do use the collateral in their houses to support their businesses. But is that what you want to do, to consistently be putting at risk that nest egg to cover those losses? Eventually that will run out as well. So the better way to approach this is to keep an eye on those margins, to keep an eye on those costs, and to make sure it's all working so that you don't have to fill that gap with what's traditionally happening, ATO arrears and/or owner's equity, tapping into the bank, tapping into your house, etc.
Great, thanks for that.
Okay, so this is pretty much what we spoke about the financial, I spoke about with the financial fundamentals, the things that small businesses are focusing on based on that that survey that we've seen. But just to reiterate the issues: margins and pricing, regularly review those, cost overruns, track them, efficient data systems. The number of clients that I see with antiquated, out-of-date data management systems, it's by the time you find out a problem's there, if you don't know about it, you can't fix it. So an investment in those sorts of technological improvements are invaluable. You need to know if you're making money, and you'd be surprised by how many businesses don't even have the basics. It's like, well, how would you know? It might have been all right when things were going swimmingly and there was surplus at the end of the month, but you need to know accurately what's going on in your business. Debtor management, cash flow, it's the same sort of thing. Monitoring your receivables, recovering them, and strict payment terms. Supply chain, similar situation, and basically avoiding those debt spirals of seeing those losses, financing those losses, paying more for the interest rates when you've got to go out and seek the expensive, cheap bridging finance to get you through the different months, which then adds to your overheads, which then leads you to this debt spiral, which then it ends up, you know, well, depends where you want to end up, whether you end up in insolvency or not. So they're the sorts of things that I see out there. Can you go to the next slide, please? Oh, sorry, that's, I think that's one of yours, is it, Ivan's?
Yeah, it was just going to make the point, of course, that while trade payment defaults are a really good indicator of insolvency, also if the ATO, if you've got a tax default. So this is our data that we get from the ATO. It's ATO data, sorry. And what we've looked at, if you have a tax default of over $100,000, then the probability of that business becoming insolvent over the next 12 months, so we've measured this from the start of May 24 to the end of April 2025, it's very high. Now, some of these, there's not a lot of insolvencies in some of these sectors like mining, but it's a very, very big red flag, and it's certainly something you want to check when you're doing your credit reviews. Does your customer have a ATO tax default outstanding against it? And that's one way to avoid potential problems down the track. Do we have there? That's probably your next one, Ginette.
Yeah, thank you. So the other thing I'd add to, could we just go back to that last slide for a sec?
Sure. There is a bit of delay, so it's coming.
Ah, there we go. Yes, look, I thought another potential indicator of insolvency, if you didn't have access to this, but you do have access to CreditorWatch company search, is the changes in the director appointments or shareholder movements. You know, sometimes when you see those Form 484s, Michael, you'd be familiar with what I'm talking about. When we have a flurry of changes of directors, or we have a flurry of changes of shareholders, there's a bit of a movement of the chairs going on. They usually pop up. I know I get the CreditorWatch alerts, and they pop up and they go, something's happened on the list, on the register. And I mean, as much as anything, to me, it's kind of like, oh, that's a good opportunity to call my client and ask them what's going on. Hi, I saw this pop up. What's happening in the business? You sold some of your shares, or you've got a change in directorship. It's usually worth asking the question, I think. Doesn't always mean that it's insolvency. Sometimes it's just, oh no, we've moved office. But anyway, it's something to consider.
The other thing to consider in relation to this ATO tax debt default data is that of the records that we have received from the ATO, and I should point out that this data goes to all credit reporting agencies. There's currently around 30,000 records, and around 16,000 of those are sole traders. So that is a very disturbing statistic when you consider that there are, all these small businesses out there carrying these massive tax debts. You just wonder how they'll go forward with that.
Okay, next slide, thanks. So I suppose we're getting to the pointy end of the business in terms of insolvency when we start thinking about a company that's perhaps not addressed all of those issues. For whatever reason, they've found themselves in this situation. Maybe the economic activity is not there. For whatever reason, they're looking at potential insolvency. So what's the response? Basically, we've tried to apply the financial fundamentals. For me, that's where I would start with the business. Have you looked at margins? Have you cut out all the dead wood? Have you trimmed the sails as much as you possibly can? And whilst we're doing that, consider putting the company into safe harbour, because there's a very good chance that the company might be insolvent or about to become insolvent. And anyone who's watched me on CreditorWatch before will know that we've talked about safe harbour before and what that's all about protecting a director in the event of implementing a better outcome plan and making sure that they don't end up personally liable for insolvent trading. So you've put in place all of those things. You've perhaps achieved a lot of that, and you've got the business right-sized, and it's making a profit because you've addressed all of the issues, but unfortunately, there's just too much debt there to get you over and on your way. So basically, you're going to fail anyway because you've created too much of a debt burden for the business, even though it's right-sized and perfect now. What do you do about that? Well, that's when the small business restructuring process might come in handy for you, and you might be able to get a reprieve from your creditors that things are going to be much better now. You've addressed all of the issues that were holding you back. You have to explain yourself, say what you've done to improve things, why things are going to be different moving forward, and of course provide cash flows to your creditors to prove that this is the case. Then you might be fortunate enough to be one of those 3,000 businesses per year that gets a restructuring plan put in place. And so that's one of the options. Another option might be voluntary administration. Another option might, although that's very expensive comparatively speaking, when you think that small business restructuring is significantly cheaper because the director remains in control of the business during the administration. So there's no insolvency staff running around touching the business during the 7 or so week period of small business restructuring, which is one of the major reasons why it's so much cheaper. So those are some of the options. Another option might be just, obviously to inject more capital, sell part of the business, sell the business, bring on a partner, lots of different options to respond to the situation before you actually consider putting the company into liquidation. I would always say that that is a final and last resort, but obviously there for a reason, and obviously being utilised based on the numbers of the statistics that we showed in the first slide.
All right, we might wind it up there, but thank you, Ginette and Ivan. We certainly covered a lot of ground today and hopefully provided some food for thought for everybody. Thank you also for attending, everyone. We hope that you found this information to be worthwhile. Look out for our Business Risk Index out next Wednesday. You can subscribe for free at creditorwatch.com.au/Business Risk Index. Thank you again, and we'll see you next time.